This presentation is for Chapter 4, Part 2, Statement of Cash Flows. The statement of cash flows is an important analytical tool for creditors, investors, and other users of financial statements that helps determine the ability of the firm to generate future cash flows, to meet cash obligations and future financing needs, and implement successful investing and financing strategies. It is possible for a company to be profitable and yet unable to meet cash needs, including paying dividends, investing in new equipment, and servicing existing debt. It is even possible for a highly profitable firm to go bankrupt. The ongoing operation of any business depends on its success in generating cash from operations. It is cash that a firm needs to satisfy creditors and investors. Temporary shortfalls of cash can be satisfied by borrowing or other means, such as selling long-lived assets, but ultimately a company must generate cash. When interest rates are high, the cost of borrowing to cover short-term cash needs can be out of the reach of many firms seeking to cover temporary cash shortages. When inflation is high, the meaningfulness of net income is distorted because of the increases in the replacement cost of goods and the understatement of depreciation expense. In the example discussed in your text, the author uses a fictitious company called No Cash Corporation to illustrate hidden problems with profitable companies. No Cash Corporation showed sales increasing from $50,000 to $100,000 and cost of goods sold increasing from $40,000 to $70,000. No Cash Corporation tripled its net income from year 1 to year 2 from $10,000 to $30,000. What the income statement didn't show was that the increased sales resulted from an easing of credit policies that attracted lower quality customers, and that near the end of year 1, No Cash purchased an additional line of inventory that it was unable to sell at a profit. Rumors regarding the problems at No Cash caused its suppliers to refuse to sell goods on credit to No Cash. This is No Cash Corporation's comparative balance sheet for year 1 and year 2 with changes in the accounts. As we can see, there has been no increase in cash. No Cash Corporation's income statement on a cash basis shows that its cash flows from operations was actually a negative $10,000. The difference between sales on an accrual basis, $100,000, and on a cash basis, $80,000, was $20,000, which was the amount by which accounts receivable increased from year 1 to year 2. Also, the increase in inventory of $15,000 was equal to the $75,000 of inventory purchased minus the $60,000 of cost of goods sold. Last, the accounts payable balance decreased by $5,000 because the company could no longer obtain credit from suppliers and was forced to pay cash for inventory purchases. The increase in notes payable of $10,000 was from short-term borrowing that enabled No Cash to continue to operate. Unless No Cash can generate more cash, its cash problems will only get worse because it will also have to pay interest on the borrowings. Bankers refer to this situation as a company selling itself out of business. An analysis of the statement of cash flows for Sage Inc. will begin with its operating activities, including cash inflows and outflows. When an analyst is reviewing operating activities to be considered, areas to be considered include whether the company is generating positive or negative cash flows from operations, as well as any underlying reasons for the cash flows, the magnitude of the cash flows, and whether or not there have been significant fluctuations in cash flows from operations over time. This is the operating activities section of the statement of cash flows for Sage Inc. for the periods ending December 31st, 2016, 2015, and 2014. As shown in the statement, the cash flows from operations for 2015 were negative, even though the company had positive net income in this year. The cause for negative cash flows was that the company experienced substantial growth in both accounts receivable and inventories during this time. The increases were due to the firm's expansion policies, and the company was able to return to strongly positive cash flows in 2016. It would be necessary to continue to monitor the cash flows from operations and the management of the company's inventories. A summary analysis of the statement of cash flows is important because it provides an approach to analyzing the statement of cash flows over time using comparative data that highlights the importance of internal cash generation from operations and the implications for investing and financing activities when cash is not being generated from operations. This is an illustration of the summary analysis of cash flows for Sage Inc. for 2014 through 2016. The columns in the exhibit show the dollar amounts separated into inflows and outflows for the 3-year period. The columns in between show the percentages for each of the inflows and outflows based on the total inflows and outflows for each of the years. Based on the summary analysis for the 3 years, we can see that operations supplied 62% of the cash needed in 2016 and 73% in 2014. The firm had to heavily borrow in 2015 with debt, both short-term and long-term, accounting for 98% of the cash inflows. Sage Inc. also borrowed in 2014 and 2015 to meet cash needs not provided by operations. Generating cash from operations is the preferred method for obtaining excess cash to finance capital expenditure and expansions, repay debt, and pay dividends. Using external sources to generate the majority of cash year after year should be investigated further. Sage reduced purchases of property, plant, and equipment in 2015 compared to 2014. The capital expenditures increased in total dollars from 2014 to 2015, but not in percentage of total outflows due to the negative cash from operations. Dividends increased from 2014 to 2015, but decreased from 2015 to 2016, and decreased as a percentage of total outflows in each of the years after 2014. Capital expenditures were covered by cash from operations in 2014 and covered by borrowing in 2015. In 2016, cash from both operations and borrowing were used for capital expenditures. Not only does the analyst have to consider the necessity of cash outflows, but also how the outflows were financed. In general, it is best for firms to finance short-term assets with short-term debt and long-term assets with long-term debt or issuance of stock. Financing acquisitions and capital expenditures with short-term debt is risky because the firm may not generate sufficient cash flows quickly enough to repay short-term debt. Repayment of debt is a necessary outflow. If the firm has generated cash from debt in prior years, a cash outflow in a subsequent year to repay debt will be required. The notes to the financial statements reveal future debt repayments and are useful in assessing how much cash will be needed in upcoming years to repay outstanding debt. When reviewing the cash outflows, it is important to review the company's dividend policies. In theory, firms should only pay dividends if the company has excess cash not needed for expansion, property, plant, or equipment, or repayment of debt. Analysis of the quantitative information from the statement of cash flows is important, but there are also the same kind of qualitative issues for the statement of cash flows that affect the balance sheet and the income statement. Management can record operating activities as capital expenditures to slow down their effects on net income, as well as disguise them as investing activities, increasing cash flows from operations. Management of current asset and liability accounts can increase cash flows from operations. For example, a company can factor accounts receivable and delay payments of accounts payable to increase cash flows from operations. This is an example of the direct method for determining cash flows from operating activities for Sage Inc. The direct method shows cash inflows and outflows for operations in specific categories, which the FASB determines. When the direct method is used, the FASB also requires a supplementary schedule showing cash flows from operations using the indirect method. This illustration shows the balance sheet accounts that are used to adjust the accrual basis income statement amounts to cash inflows and outflows under the direct method. The cash inflows are cash collected from customers and from interest and dividends received. The cash outflows include cash paid to suppliers, employees for operating activities, taxes, and interest. This is the end of Chapter 4, Part 2, Statement of Cash Flows.